Welcome to another edition of Foundations of Accounting and Finance. We continue with what we did in the last session. We're going to talk about return risk and then something new, that is capital asset pricing model. What is this capital asset pricing model? Why are we going to use it, or where are we going to use it? We will discuss as we go on. To continue with from where we left in the last class out there, in the last class we talked about what we call it as, we stopped at something called as describing something called as variance, and then how much does it vary. We talked about something called a standard deviation. How much does it deviate from the mean, and all those things to be measures of risk factors. Continuing the class out here, let us look at couple of aspects out here. I've just got some pictures out there. I've taken 3 companies out here. I've talked about Aditya Birla departmental store, that is the fashion and retail, Indigo air transportation, computer software, and so on. I'm not even talking about these specific companies out. I'm talking about the sector per se. If you look at the returns expected from the retail, fashion and retail industry, is about 14.47% are returns that were generated by the fashion and retail industry in the last year was about 14.47%. I'm talking about last year. Airline sector was about 10, air transportation was about 10.9, and computer software is about 11.61% out. Investment returns. Now, question is expected returns on common stock, why do they vary? How do they vary? Why do these industries expected return differ so much, and how are these specific numbers calculated is what we are going to spend time in today's class session. How does it differ? Why are they talking about? Why are they talking about these specific numbers? How do we arrive at the specific numbers is something what we are going to talk about as of today. Further, I am going to talk about, does it say that higher return offered by a department store stock, that is department store or retail store stock, does it mean that investors should always prefer that and should not prefer the other two? Am I trying to communicate that? Well, no. We will see more and more of this, what we are trying to convey out here. Am I trying to convey that? No. Why no? The question is, why am I not trying? Because I know that fashion and retail is giving me the highest return of 14.4% among the 3 sectors. Why am I not recommending that? Recommending only that. Let me rephrase it. So, let us sort of try and see as we go along. Please note, individual securities have some specific characteristics out there. These characteristics can be divided into 3 basic categories. We say expected return, we talk about variance and standard deviation, and I talk about variance and covariance also. These are the 3 basic attributes which I use for assessing the risk and deciding on my investments. When I talk about expected return, I am talking about what is the individual stock, what do you expect to earn over the next period. The actual what you get might be higher and lower than what you expect. The average, my expectation could be based on the past analysis and the prospects, what I have analyzed for the future, etc. When I talk about variance and standard deviations out there, these are the attributes which I sort of use and analyze. Is I am looking at the volatility of the security, as I said in the last class. I am looking at the variability in the security. I am looking at how much does it vary from the mean, from the average. If it varies higher and higher, then the risk is expected to be higher and higher. If the variance is low, then what happens? Your or the standard deviation is basically low, then the level of risk, that is your is relatively lower. Now what do we say? Imagine on an average you will get a 10% return. If my variation is only about very small, let us say it varies anywhere between 9.5 to 10.5 maximum. So on an average expected return is 10%, that is based on the past. Now I see the variance between 9.5 and 10.5. That means what? I will either get 9.5 or 10.5 or somewhere in between 9.5 and 10.5. So what happens? The variability, the difference from the expected return is going to be very, very small. So the level of assurance that I will have to get somewhere around 10 is very high. So the level of risk is low. If the variance is high, for example, if I say average last year was 10, but the variance is anywhere between 7.5 to 13.5, there is a probability that you will get 13.5. Very good. That there is a probability that you will get 7.5 also. So what happens? That is, you may the variation becomes little larger in this particular case, and the variation in the lower bound is what we talk about. That is it will you may not get. You may get anywhere between 7.5 and 10 or 7.5 and 13.5. So what happens? Your level of risk enhances substantially, and that is what we talk about when we say variance and standard deviation. These are the essential characteristics which we try and analyze. These are the essential characteristics which we try and analyze when we are investing in an individual security out there. So it goes back to the reason out here, that is, it goes back to the reason that why am I not recommending? Because I am looking at the variability. For example, it is I don't know what is the average mean of investing in the department store sector out there. Maybe it has given the other side, the other side of the mean, the positive side of the mean. So it is about 14.5, 4.7. You could look at the downside. The downside could be even larger variation out there. The variance in this could be very, very high in the retail sector as compared to the computer software sector. So do I recommend this? No, I may not recommend this as a top notch. I would sort of say, at least here you have an assured, the level of assurance what you will have on getting 11.61 in around that figure in a computer software sector could be relatively higher. So I will sort of recommend it. So what happens? So one of the characteristics is variance and standard deviation. The next one, what we look at is covariance and correlation. It is nothing but it measures the interrelationships between two securities. How much does it covary? For example, where do you use this? I will use it when I sort of look at diversification of my investment. When I am losing at a single stock of my investment, I am looking at what is called as variance and standard deviation. Or every stock I am going to invest, I am going to look at variance and standard deviation. When I'm going to invest in an array of instruments out there, I am going to look at the covariance and correlation. Imagine two stocks which are highly correlated. If I sort of say I put 50-50 in each of these and highly positively correlated, let us also say that highly positively correlated, and if I have $100 and I put 50 in both of it, the probability of me getting higher money is the same in both, or the probability of getting lower money is the same in both, and both will move in exactly the same direction out there. I am not hedging my risk out there. Supposing they are negatively correlated, highly negatively correlated, so what happens? I put 50-50 in each. One goes up, the other basically comes down out there. To a certain extent, my return is basically protected in this case. So when I look at, I'm just taking an example. I've taken two simple stocks out there. That is two simple stocks. That is, there are states of the economy: depression, recession, normal, and boom period. Now, the first column, what says, it basically talks about only the probability of depression occurring, and if depression occurs, there is a 20% probability that depression will occur. Now let us look at depression. In depression, there is a probability of 20% probability of depression, 0.2. If there is a depression, the A stock will give me a negative return of 10%, and the same depression for stock B is only 15%. And if it has a 15% depression, it will give a negative return of 22% out. And I look at recession, there is a 25% probability that there is recession in stock. Recession will impact stock A. There is a 30% probability it will impact stock B. And what is the kind of return you see there, and what is the boom period? There is a 15% probability that there will be a boom period for stock A, and if it's a boom period, it will give me 12% return out. If it's for there's a 10% probability that there's going to be boom period for stock B, and if it's a boom period, it's going to give me 32% return out. Huge. Now I want to know what is the expected return of these two stocks. Let us try and see if we can use an Excel out here. I'm just going to copy this on an Excel sheet. On an Excel sheet out there. Let us copy this on an Excel sheet out here. I'm just going to, yeah. I'm just going to copy this for the. I'm just going to copy this on an Excel sheet out here. I'm just going to copy this on an Excel sheet out there. Let us try and see. I'm just going to copy this on an Excel sheet out here, and then I just copy this, and don't worry, I'll just going to adjust the cells out there, length out. Fine. Now, this is a basic aspect what you have. This is the state of the economy, and this is the kind of what you call it as the returns that you are basically going to get for the two stocks out here, and it's mentioned. So, what is the idea? Expected return, expected return. I will add a, what do you call it as a row here, and then I will mention what is it, probability, and this is what is called as return. And this is what we call it as the return out there. This is just the probability, and this is the return in this particular case. Let us, I'm just going to increase the size of this out here, and this is the what do you call it as the return out here. That's basically what we have out here in this case. Now, what is the expected return? The expected return in this particular case is going to be nothing but what do you call it in this particular case is number one, the probability of the first event occurring, that is depression occurring, and the probability of that return occurring, plus the probability of the next event occurring into the return that I would get in the next event out there, into the probability of the third aspect, that is normal situation occurring, into the return that I will get on the normal situation, and the probability of the boom period occurring, and the return that I could expect in this particular case. And in this particular case, if I say that this is going to be my return, I'm going to express it in the form of a percentage out there. It's going to be 1.075. The expected return is going to be only about 1.075, 1.075% out there, where there are significant negative returns. Whereas when I look at stock B in this particular case, when I look at what do you call it as when I look at stock B in this particular case, let us see. And look at stock B in this particular case, I'm going to look at stock B out here. Stock B is the probability of depression occurring is 15%. What is the return I can get? Negative 22% out there. The probability of a recession occurring is 30%, and I might get a 12.5% negative return. And the probability of a normal phase is 45%, and the return is 5.5% out there. And the probability of a boom phase occurring is 10%, and the return that I'm going to get is 32% out there. And this is going to be my return in this particular case, and I am going to get a return again in this particular case is negative 1.375% in case of stock B. So, this is how you basically calculate what is called as the expected return of a particular stock. What is the probability of each of these kind of situations occurring out there is what you will take and you will consider out there. We move on further in this particular case. I've got take two simple stocks. It's example one. That's fine. That's okay. Now I'll now move to the next stage. That is what we call it as the expected returns, variance, and covariance out there. Now, expected return we saw. Let us look at another example. Example two. Supposing financial analysts believe that there are four equally likely states of economy: depression, recession, normal boom. That's what we saw now. The returns of super tech, this is again an example from the textbook that is I have prescribed out there. Super tech company are expected to be expected to follow the economy very closely, while the returns on the slowpoke company is not going to be. The return predictions are as follows. Now, what is the expected return? What is the variance? What is the covariance? That is what you guys have to calculate out there. Variance means how much does it vary from the mean. Covariance means how much these two basically vary together also is what we are looking at in this case. Let us go to the Excel sheet. The Excel sheet I have basically built in what you call it as the probability, because if you look at this particular problem, what do they say? They say that all four equally likely states. That means what happens? There is a 25% probability that there is a recession, there is a depression, there is a normal period, and there is a boom period. And they have given you the returns, expected returns in this particular case, as you can see out here, minus 20, 10, 30, and 50, and that's exactly what I have taken out here in this case. Right, the same thing I have done for what do you call it as the slowpoke out here, the two basic companies we have taken. Let us find out what is the expected return, what is the variance, and what is the covariance, and what is of course the standard deviation. Let us sort of go ahead and do this. So what is that? First of all, I need to know what is the expected return. What is the expected return? As I told you, expected return is the probability of each of the state occurring into the return in that particular state occurring out there, the summation of all that. That is, if I have to put it, that is there is a 25% probability that depression will occur, and if depression occurs, there is a negative 20% is the kind of return I am going to earn, and each of these particular state out there I am just multiplying and putting it out here in this particular case, and what do you call it as this out here. So, expected return is nothing but a summation of all these states, and this is what is my expected return. What are we trying to calculate? We are trying to calculate the variance. Variance means what? This is that 17.5% or 0.1750 or 17.5% is the mean, is the average of all this expected. How much does each of these state vary, differ? How far are these from the mean is what we calculate, and that is what we call as the return deviation out there. Return deviation out there, that is, this is the return what we have minus this is the kind of return what we are looking at, and this is what we call it as the return deviation out there. This is the return what I will get minus what is the expected return, that is average is what I am looking at, and each of these state that is minus what do you call it as this, and then when we talk about in this particular case, this is what it is minus this what we get, and this is the return that is deviating from the mean. What are we looking at? We are looking at the squared deviation. Variance is what? Squared deviation out there. Standard deviation is what? Square root of that variance. Squared deviation. So, what do? I just square this out here, that is I just square this, I just square this out here, that is all what I am doing. I just square this out here so that the negative what is also taken care of. I just square this out here, and then the negative part is also addressed in this particular case, and yeah. So, I think the return deviation here is slightly wrong. Yeah, I think I just put the one picture earlier. It should be from 23. Yeah, that's it. So, what happens? My return deviation out here, and then that is what it is. But what is the probability of the squared deviations occurring? There is a probability here. There is a squared deviation. What is the squared deviation? There is a probability that the squared deviation occurs. there is a probability that the squared deviation occurs. What is the probability that the squared deviation occurs is basically I need to look at what is the probability that the squared deviation occur is basically multiplied by the probability out there. What is the probability that the squared deviations occur is basically. So, what is it we are looking at in this particular case out here? What is the variance? Variance is nothing but summation of all this is what we call it as the variance out there. Variance is nothing but summation of all these product with the probabilities is what we call it as the variance. Then what is the standard deviation? Square root SQRT of what we call it as the square root of the variance is what we call as the standard deviation, and that is where it is 25.86% is the deviation from the mean. The deviation from the mean is large. Can I do it for slowpoke? The same thing. Yes, I have it out here. I am going to do it for slowpoke. What is it? Probability of the return occurring. That is the first thing, because I need to find out the expected return. I need to find out the expected return and the probability of the return occurring. What is the expected return? Expected return is at some this is the expected return. I can express it in the form of percentage. What is the return deviation? This is the return minus what is the deviation from the mean out here is what I am going to enter out here. This is the return. What is the deviation from it from the mean out here is what I am going to enter. This is the return, and this is the what is the return deviation from the mean is what I am going to enter, and this is the return, and what is the kind of deviation from the mean is what I am going to enter here. Now, I need variance, so squared deviation. I am looking at squared deviation out there. I am looking at the squared deviation. I am looking at what do you call it as a return in this particular case. I am looking at the squared deviation in this particular case. I am looking at the return out here. I am looking at the squared deviation out here. So, I am just looking at the squared deviation. Probability of the squared deviation occurring, the probability of the squared deviation occurring, I have to just multiply this with the probability out here, multiply this with the probability out here, multiply this with the probability out here, and multiply this with the probability out here, out there, and that is all what I am basically going to do in this particular case out here. So, what is the variance? Variance is sum of this is the variance. What is the standard deviation? Square root SQRT of the variance is nothing but the standard deviation. The standard deviation of this is 11.5%. So, what happens? The deviation from the mean, though it gives you only about 5.5% expected return, whereas the other one gives you 17.5% expected return, the deviation that it is going to have from the mean is very less as compared to the other. The deviation is going to be significantly large. So, what happens? If you are a risk averse investor, you will choose slowpoke than what do you call it as a other company out there in this case, Supertech. Now, in the next step, I am going to do a little bit of what do we call it as the covariance and correlations out there. I just have the deviations from the return. I am just going to copy those deviations from the return out here. I am just going to copy these deviations from the return out here. I am just going to copy this deviations from the return of slowpoke, and same thing. I am looking at the covariance. So, I am looking at the what do you call it as the same thing out here. I am going to copy the deviations from the return out here in this case. Now, I need to look at the covariance. So, covariance is basically thus into the product of these two variations out there. That is, I am looking at how well these products are, what do you call it as related out there. I am looking at that, and basically I am going to total this up, and that is going to give me a number. Now, let me look at covariance. Covariance is the deviations of both these from the mean. I am just summed it, the total of this divided by what you got, how many observations are there? 4 observations are there. I'm just going to divide it by 4, and that's going to give me the covariance in this is going to be what we call it as the negative 0.49, or if I had to express it in the form of percentage, it's minus 4.88 minus 0.488% is the covariance out there. It is negatively correlated. Sorry, negatively negative. It has a negative covariance. What is the covariance? Covariance is nothing but correlation is nothing but my covariance divided by the standard deviations, the score, the product of the standard deviations out there, and that's going to give me my correlation. Correlation is 16.39% out there. The correlation between these stocks. Now, what happens? These two stocks have a expected correlation of 16.239% out there, and it has a covariance of about 4.8.